Welcome to vTalkInsight Allocator's Lens Daily for January 19th, 2026. Global risk assets are riding a broad equity rally and tight credit spreads, while rates and currencies stay surprisingly calm and commodities absorb most of the geopolitical stress. Today we connect the AI investment boom, higher for longer interest rates, and volatile energy markets into one cross-asset picture for allocators. In equities, the dominant feature is how broad the rally has become. All the major country indices being tracked are trading above their 200-day moving averages, and advanced decline lines are pushing to new highs, which signals unusually strong participation across regions and sectors. That breadth is now visible inside the United States as well. Equal weight benchmarks and mid-cap indices are outpacing the traditional cap-weighted S&P index, and small caps have strung together a notable run of outperformance. The rally is also spreading beyond technology into areas like utilities, software, and infrastructure, suggesting a more inclusive uptrend than we saw earlier in the cycle. The case being made for further upside is increasingly earnings-driven rather than valuation-driven. Commentators see scope for S&P gains of around 10 to 12% this year, coming largely from profit growth, with little room for multiple expansion from already elevated levels. Across the index, corporate earnings are expected to grow at double-digit rates, and that expectation is even stronger in the technology complex. AI-related franchises sit at the center of that story. Semiconductor leaders such as TSMC, SML, and major memory names have rallied on record results, higher capital spending plans, and evidence that AI demand is outstripping supply. Hyperscaler capital expenditure growth forecasts are being revised higher, and the AI infrastructure build is seen as a multi-year, not a one-year phenomenon. Against that backdrop, many analysts argue that core AI valuations are fundamentally supported rather than purely speculative. Below the megacaps, there's been a decisive shift in favor of smaller and more cyclical names. Small caps have outperformed the S&P for several sessions in a row, helped by more upbeat management commentary and faster upgrades to their forward earnings than for large caps. Earnings forecasts for U.S. small caps have been lifted far more aggressively than for the broader market, reinforcing the idea of a durable rotation rather than a brief squeeze. That micro picture sits on top of an unusually supportive macro mix. Growth trackers are pointing to stronger than expected real activity. Jobless claims hover near multi-year lows, and productivity has surged while unit labor costs have fallen. Forecasts call for GDP growth to firm toward roughly the mid-twos this year, helped by tax incentives, AI-related capital spending, and accelerated depreciation. Taken together, that looks like a classic soft landing backdrop for risk assets. The flip side is that the bar for companies to impress the market is rising fast. Technology sector earnings are expected to grow close to 30% this year, roughly double the pace of the next best sector. That leaves little margin for disappointment around AI monetization, energy costs, or regulation. There are also visible pockets of consumer and housing strain, from depressed existing home sales to record new vehicle prices and heavier auto loan burdens. Several voices warn that complacency is creeping into cyclical sectors after such a powerful run, and that a pullback would not be surprising even if the full-year story remains constructive. Valuation work suggests index levels could stay elevated while multiples compress, especially if disinflation continues and rates stay higher for longer. For allocators, the key equity question is how this earnings-led bull market interacts with a central bank that is in no rush to cut, which brings us to rates. Rates markets are converging on a view that policy will stay restrictive for some time. Federal Reserve officials have been clear that they see little urgency to cut, while inflation remains above target and activity data are solid. The base case being discussed is now only 1 or 2 cuts in January 1st, 2026, and even that is conditional on price pressures easing toward roughly 2 to 2.5%. Over recent weeks, expectations for earlier and larger cuts have been pared back, with the first move now pushed toward mid-year rather than spring. Speculation about more hawkish leadership on balance sheet policy has helped nudge Treasury yields higher, and the 10-year has broken above roughly 4.2%, which some read as the start of a move to a higher trading range for long-dated rates. Alongside that, the yield curve has been flattening. The spread between 2-year and 10-year Treasuries has narrowed by more than 10 basis points this month as front-end yields edge up while the long end holds broadly steady. The 30-year bond sits near the high fours, and labor market resilience is seen as a key factor keeping 10-year yields anchored around current levels rather than sliding lower. Markets appear comfortable with a soft landing scenario of steady growth and only modest eventual easing. At the same time, large fiscal deficits, political noise around the Fed, and leadership uncertainty keep term premia in focus. This combination of higher for longer policy rates and a relatively calm long end is a central constraint for both equity valuations and credit risk-taking. From a portfolio perspective, the message is mixed but very clear. On one hand, robust demand for fixed income reflects the appeal of today's yields, especially when set against stretched equity multiples. Investors are gravitating toward shorter and intermediate maturities to collect income while limiting exposure to long-end volatility linked to policy or fiscal surprises. On the other hand, with rate volatility still subdued, there is a risk that the market is underpricing how sensitive this equilibrium is to incoming data. A string of softer inflation prints could revive talk of earlier cuts, while any renewed energy or wage shock would reinforce the higher for longer camp. Those rate paths will feed directly into credit spreads and currency moves, which are the next parts of the picture. Credit markets are telling an even more optimistic story than rates. Spreads in global corporate bonds have tightened to levels last seen in 2007, reflecting a powerful combination of strong demand, high all-in yields thanks to policy rates, and generally solid corporate balance sheets. In high yield, spreads also sit near historical tights, yet technicals remain favorable and investors see little immediate pressure for widening. Major asset managers, however, are increasingly vocal about complacency risk. They point out that the lower half of the U.S. economy is not as healthy as the aggregate data suggest, and that today's tight spreads leave limited compensation for an eventual slowdown or a policy mistake. The contrast between bullish pricing and late-cycle concerns is one of the sharper tensions in today's cross-asset landscape. Under the surface, several structural themes stand out. Record issuance is coming from sectors linked to AI and utilities, as companies finance data centers and power infrastructure to meet surging digital demand. Some of the largest U.S. technology firms can now issue debt at tighter spreads than certain developed market sovereigns, flipping the traditional hierarchy between countries and corporates. That strength is positive for benchmarks, but raises concentration and asymmetry risks for credit investors. There are open questions about whether current spreads fully compensate for future supply and for policy shifts such as potential caps on credit card interest rates. Those measures are still viewed as low probability but high impact, with the potential to constrain consumer credit availability and ripple through parts of the banking and consumer sectors. Positioning along the curve echoes what we see in government bonds. Investors favor shorter to intermediate corporate maturities to lock in attractive yields while staying less exposed to swings in long-dated rates and term premia. Even with spreads at cycle tights, the income component remains compelling versus cash for many, especially in investment grade. At the same time, the combination of tight spreads and elevated macro and regulatory uncertainty means the asset class is vulnerable to a change in narrative. A growth scare, a sharper regulatory push on consumer lending, or an external shock could quickly widen risk premia from very compressed starting points. That makes it important to watch how credit interacts with both rates and currencies, particularly as global policy divergence shows up most clearly in foreign exchange. Foreign exchange markets look unusually calm compared with what is happening in equities, credit, and commodities. Implied volatility has stayed low even as headlines around policy and geopolitics pile up, suggesting that traders are waiting for concrete actions rather than reacting to every threat. Within that tranquil surface, the US dollar sits at an interesting pivot point. Positioning is no longer heavily skewed toward long dollars, so stronger than expected US data could generate a fresh leg of dollar strength, especially against lower-yielding currencies. At the same time, medium-term narratives still anticipate eventual dollar softness once the Fed does begin to ease and reserve diversification into gold and other assets continues. For allocators, that leaves the dollar more data dependent than it has been for some time. The Japanese yen remains the key pressure point. It has weakened to levels last seen in the early 1990s, driven by a mix of fiscal strain, still low domestic rates, and Japan's gradual rather than aggressive shift toward monetary tightening. Authorities have stepped up their rhetoric as dollar-yen approaches the 160 area, and there's a clear risk of intervention, particularly during thin U.S. trading sessions. Yet most observers argue that durable yen strength will probably require a more hawkish Bank of Japan stance, not just one-off currency operations. Meanwhile, outside traditional FX, crypto assets like Bitcoin and Ether have logged strong weekly gains even after leverage washouts, signaling that speculative risk appetite is alive. Progress on a comprehensive U.S. regulatory framework for stablecoins and digital assets remains slow, so policy clarity is still a medium-term rather than an immediate driver. Commodities are where much of today's macro and geopolitical anxiety is being priced. In oil, tensions around Iran and the broader Middle East remain a key source of upside risk. The deployment of additional U.S. military assets and the potential for further sanctions raise questions about the security of roughly 1.5 million barrels per day of Iranian exports, and about flows through the Strait of Hormuz, which carries a large share of global seaborne crude. For now, global supply and demand look relatively balanced, and crude prices have eased from earlier spikes, even dipping below $60 at one point as some tensions cooled. That cushion gives policymakers more flexibility, but does not remove the asymmetric risk of a sudden disruption. Any sustained move higher in oil would quickly feed back into inflation expectations, central bank decisions, and ultimately equity and credit valuations. Gold continues to serve as the preferred hedge against that complex backdrop. Prices remain elevated, only modestly below recent records, and some large private banks are openly targeting further gains toward the low 5,000s per ounce by year-end. They point to ongoing central bank diversification away from the dollar and the persistence of geopolitical flashpoints as key drivers of structural demand. Equity investors are also paying attention to gold miners, where strong cash flows and earnings give leverage to any additional upside in the metal itself. Miners are seen as undervalued relative to bullion, offering an alternative way to express a view on persistent uncertainty. The broader message is that even in a risk-on environment for equities and credit, there is steady appetite for real asset hedges. Industrial metals present a more nuanced picture. In the near term, regulatory moves in China to curb high-frequency trading have triggered sharp moves in copper, zinc, and aluminum, pressuring mining equities, particularly in Europe. Yet looking out toward 2026, some large institutions expect a cyclical recovery and broader growth to lift industrial metals, supported by infrastructure investment and AI-related demand for materials like copper and tin. A critical link between technology and commodities runs through electricity. Heavy AI data center spending is driving a surge in power demand, with some facilities securing gigawatt-scale capacity. Competition for power in regions like Texas is intense. Wholesale prices in parts of the grid are being pushed higher, and policymakers are considering long-dated contracts and separate pricing tracks for data centers. That raises operating costs for large tech users, but underpins investment in generation and transmission, with knock-on effects for inflation, rates, and energy-exposed equities and credit. Stepping back, the cross-asset picture lines up as a confident but finely balanced risk stance. Equities are enjoying broad and earnings-driven momentum, turbocharged by AI and fiscal support, while rates markets endorse a higher for longer path and credit trades at spreads last seen before the global financial crisis. Currencies remain calm, masking meaningful risks around the dollar and the yen, and commodities have become the main outlet for hedging geopolitical and energy uncertainty through oil and gold. For allocators, the key tensions to watch are between an AI-led capex boom and the power and inflation pressures it creates, between tight credit spreads and late-cycle policy risks, and between a patient Federal Reserve and markets that still price an eventual easing path. Cross-asset signals today point to a soft landing base case with clear asymmetric risks around geopolitics and energy. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.